Hey everybody, Marty Mazura. This video is primarily for clients. I'm going to explain why we maintain our global posture when it comes to managing client portfolios and why I think it's going to be so important that we continue to do so in the years to come. I'm going to start with some information. I'm going to talk a little bit about demographics and opportunities the world over. That's going to be part one. In part two, I'm going to take you through some charts and I'm going to show relative performances. I'm going to show the fact that the US for several years now has been outperforming most non-US markets. And I'm going to make the case that returns tend to revert to the mean, as do valuations. So I think I'm going to make a pretty compelling case that going forward the next few years, we may see something like the phenomenon we saw between 2000 and 2010, and that's where the rest of the world markets actually outperform our US exposure. So to begin with, folks, you and I, us Americans collectively, occupy, believe it or not, just 4% of the world's population. And when we include the rest of the developed world, Western Europe, Canada, Japan, Australia, New Zealand, and so on, we in the developed nations, occupy just 15% of the world's population, 15% of the world's human capital. Therefore, 85% of the people on this planet live in the emerging and developing markets. Markets where the average age is substantially younger than in developed markets. Markets where infrastructure investment is going to be needed the most, and therefore opportunities will abound in the industrial sector, technology sectors, and so forth, both in the developed markets that make investments into these emerging markets and also in companies within the emerging markets themselves. And make no mistake, folks, these growing populations are the target for major US companies today, and they will be for many, many years going forward. Now, of course, we can't have a conversation about international investing without at least discussing some of the risks that abound outside of our borders. The most recent, of course, was what is called Brexit, the UK's decision to exit the European Union. The ongoing European debt crisis, which today is most visible in the Italian banks, problems that have yet to be remedied by the powers that be. Problems that ironically create great opportunities in that they can depress the price of stocks of companies that you and I know quite well, the companies that produce the products that we find in our kitchen cabinets, on our bathroom shelves, opportunities to pick up stocks of companies that are domiciled in areas that have structural and perhaps political issues, but that also provide stuffs that the developed markets and the emerging markets thirst for quite aggressively. Opportunities that smart, value-oriented investors constantly seek out on the global stage. So with that as our backdrop, now we start part two, where I'm going to take you through the past 3 decades of performance, comparing the US to non-US markets. I'll get specific and talk about the Eurozone. Again, we're going to talk about valuations, and we'll start with the last half of the 1980s. So the chart you have in front of you illustrates the Morgan Stanley Europe, Australia, and Far East Index. That's the orangish line. The S&P 500, which is the white line, and when we can pick up the blue line, which is the Morgan Stanley Emerging Markets Index. As you can see, for the last half of the 80s, developed non-US markets substantially outperformed both the US and emerging markets. And then as we enter into the 90s, as you can see, the first half of that decade was dominated by the emerging markets. The blue line shows huge outperformance of the emerging markets over the US, and ironically, the winner for the previous half decade, developed non-US markets, actually came in last place. Then we enter the second half of the 90s, and let's call it the technology revolution, the internet revolution, if you will, the Microsofts of the world, changing the world as we know it, making for phenomenal productivity, job growth, a great economy, particularly in the US. The last half of the 90s was dominated by the US. As you can see, the S&P 500, the white line, substantially outperformed both developed non-US markets as well as emerging markets. Then, of course, the first half of the OOs, we were introduced to what is by definition too much of a good thing, and we had the tech bubble bursting. And we can see all markets globally just took a huge hit in the early OOs. Markets bottomed in March of 2003. And as we came out of it, you can see that emerging markets emerged the victor. Then as we enter the second half of the decade of 2000 to 2010, as you can see, emerging markets continue their outperformance. And then we had the real estate bubble bursting, amazing, two monster bubbles bursting within a 10-year period, very unusual. And as we came away from that, as you can see, emerging markets continued to outperform both non-US developed and US. And you can see the US now for 10 consecutive years, the decade of 00 to 2010. Actually, if you put those together, the S&P 500 actually had a negative rate of return when you look at just the price action. Then we enter the first half of the current decade, and you can see the S&P 500 just basically takes off and leaves the others far behind. We have a huge outperformance of US stocks versus non-US developed. And then emerging markets, ironically, the winner of the previous 10 years now falls firmly into last place. Now, 6.5 years into the current decade, as you can see on this last chart, the US market, the white line, continues to outperform non-US developed and emerging markets. There was some change of leadership back in 2015, but when all is said and done, if you look at investing, 6.5 years now into the current decade, we have an unusual period of outperformance of the US over the rest of the world. And so folks, what these return charts show you is that perhaps at times it might look like chasing previous winners is a good idea. Generally, it's not. Generally, it's much, much better to diversify globally, to not make the mistakes. In fact, the stereotypical mistake of the individual investor, that's chasing returns, and ultimately, if not destroying, doing major damage to our long-term results. So now, getting into valuations, there's an old saying in the investment businesses that returns tend to revert to the mean. And when we have extended periods of outperformance, we tend to get extensions or extended valuations, if you will. The chart you see now, the top line, the S&P 500, that's the price to earnings ratio based on this year's projected earnings. The S&P is trading at about 18.3 times this year's earnings. The Europe, Australian, Far East Index, the orange line, is trading at a much cheaper level at 15, and emerging markets as a group are trading all the way down at 12 times this year's earnings. When we look at the world from a dividend income standpoint, we can see that the Europe, Australia, and Far East Index in the aggregate is paying a dividend of almost 3.5%. Emerging markets are paying 2.7%, while the S&P 500 is now paying a dividend at 2.1%. So again, from an income standpoint, valuations look more attractive in other parts of the world versus the US. In light of Brexit and other issues in the Eurozone, I thought we'd just kind of zero in and look at the US relative to the Eurozone. As you can see, the 18.3 times 2016 earnings for the S&P versus about 13.9 for the Eurozone itself. So the Eurozone looks from a valuation standpoint to be very attractive. Now, as you can see over the last year or so, it's not unusual. In fact, historically, it's not unusual for the US to trade at a higher multiple. But again, this is an unusually large spread between the two. So if we revert to the mean, folks, what we're going to see is US valuations come down, the Eurozone valuations come up, or the two meet in the middle. And in two of those three scenarios, as we can see, valuations in the Eurozone actually rise. And then looking at the US versus the Eurozone from a price to book value standpoint, you can see that the US is trading at 2.9 times, and this would be the aggregate book value, the asset value of the companies in the S&P 500 index, versus the Eurozone index companies' aggregate book value of less than half of that. So folks, clearly we know why. We know that these prices are depressed based on the issues that we're very familiar with in the Eurozone. And that, as I mentioned in the first half, is where opportunities are, of course, born, if you will. And then lastly, with my US to Eurozone comparison, just take a look at the dividend yield of the Eurozone index in the aggregate is 3.75%. versus that, again, 2.12% for the S&P 500. So that purely from a dividend income standpoint, we are rewarded substantially more so in the Eurozone versus the US currently. Looking at it again more globally, let's take a look at profit margins. As you can see, if you look at the chart, 2007, pretty much the world peaked from a profit margin standpoint. The green line there is the Eurozone, the red line, Europe, Australia, and the Far East, and the blue line is emerging markets with the US on top. And then the US peaked again in 2014 and has kind of rolled over. I'm not saying there's not some room for margin expansion, but if you look at the other lines, the Eurozone, the developed non-US markets when we fold in Australia and Japan, and then the emerging markets, as we can see, to get back to, let's say, 2007 levels, we have quite a bit more potential for growth in other parts of the world than we do currently in the United States. There's an old adage on Wall Street, never fight the Fed, and I think most of us can relate to that the last few years. As the Fed has been very easy with monetary policy, the market's actually had a nice bull market. I know it's been very flat for the last 2 years, but for the most part, when the central bank is very accommodative, keeps interest rates very low, in fact, what they're trying to do is create some inflation. One of the transmission effects, or the intended transmission effects, is the boosting of asset prices, especially stocks, so that people feel wealthier and go out and become more active economic agents. What you're looking at in front of you is the odds in the futures markets that the European Central Bank would perhaps hike interest rates between now and December of this year versus cut interest rates. And as you can see, the futures markets are suggesting that there's a 2/3 probability that the European Central Bank is going to reduce interest rates between now and the end of this year. So folks, as you can imagine, I could go on and on all day. We could talk more about the emerging markets. I could give you more texture and insight into issues and opportunities in places like China, phenomenal opportunities in places like India. But just to kind of bring it home and to sum it all up, I am convinced that the secret to long-term investment success for patient, diligent, to some degree volatility tolerant, or to a great degree, depending on your age and your temperament, volatility tolerant investors, is going to be to keep a very global mindset, to not limit ourselves to just one country, in our case, of course, the US, to expand our portfolio beyond our borders and to take advantage of the opportunities that are abundant in other parts of the world. Thanks for listening and watching.